Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead. LME 3-month copper. The break above the third of three resistances, the neckline of the February to April 2023 head and shoulders continuation pattern, currently at 84.52, back at the start of March, was the beginning of this recent move higher. This resistance was breached and broken with the rise originating from the base of the congestion between 83.46 to 84.40. The initial journey upwards was a tortuous one, yet the market built on the congestion below 84.40, plus the short medium moving average back then, and highlighted in green on my daily chart at the moment, currently at 97.50. Finally a golden cross at the start of March, that all staged an eventual move up over this neckline. So what happened next? Well, there are two parts to the answer. Over middle April to early May, the market created a bullish halfway hesitation, and both the primary target and a harder to reach secondary target were achieved. After this, prices continued travelling higher, and a few weeks ago made new all-time highs. I think it was actually 4 weeks ago. 4 weeks ago made new all-time highs. 3 weeks ago made new all-time highs. The second part of the answer has been the treatment of the action over the whole of March until mid-May, in that we made a beautiful, very acute, March-based bullish Andrews pitchfork, highlighted in dark blue on my daily chart. And the market followed this bullish pitchfork, creating a pipe top in late April, but still moving higher until 2 weeks ago when prices broke over and above the upper time, currently at 10.948, at a far steeper angle than even the bullish Andrews pitchfork. I asked this question 2 weeks ago, and I quote, "Does this mean that the pitchfork has finally failed?" Well, not necessarily. You see, it's still early enough to just be a breach, and we could see prices back down within the pitchfork again soon, end of quote. Well, later that week, and also into the middle of last week, that is exactly what happened, with prices moving back within the dark blue bullish pitchfork. Over the middle of last week, prices punched down through the lower time, currently at 10.473, and consolidated under the 2011 high at 10.190, and above previously off-mentioned congestion in stratified levels between 97.50 to 99.95. Today we are set up for a possible daily key reversal down. Thus, if we close tonight either over 10.195 or under 10.065, then we'll be on. Right now it looks very much like we have a daily key reversal down into the midst of the 97.50 to 99.95 congestion, which incidentally has the green highlighted short medium moving average moving into the frame. All this retires any ideas of a possible bullish halfway hesitation, which I started entertaining about last week, and also retires the provisional target X in the 11,200 area overhead, which I've placed there just in case. LME 3-month aluminium. Please excuse the red highlighted text on my daily chart. Sometimes my charting package decides to throw a wobbler for no apparent reason, and this is one of those times. So the red text is not necessarily anything special. So back to the LME aluminium market, and the move higher over March, April and even May originates back in late February. The market breaking higher from a diamond pattern type formed between late October 2023 to late February 2024, and it's highlighted in green on my daily chart. Now I grant you it was not the best looking diamond pattern type, but as I said repeatedly back then and ever since, it had merit, especially on the break higher. However, the market took its own sweet time in moving up to the topside targets, but get up there they did. The next feature was something I pointed out 11 weeks ago and ever since, a bullish bow tie formation of the moving averages. Now this was due to kick in between the 9th and the 16th of April. As you can see from the daily chart, in between those dates on the 15th of April was when we had the big spike higher that ended up as an indecisive doji cross of all things. This huge move showed the topside potential of the market for the next few weeks. As part of this move higher, we had a gap move up over the weekend between the 12th and the 15th of April, We spent the rest of April and early May gradually moving down to fill in this gap, which was done early 3 weeks ago. Since then, prices started moving back up through the high on the 15th of April at 27.28. Now, I spoke on this 4 weeks ago when I said, and I quote, "We need to see the gap in mid-April between 25.12 and 25.35. We need to see this filled relatively soon. If after this the market continues lower, then the recent action will have been a peak. If not, then this will become a staging point, even a possible halfway hesitation for a move higher." End of quote. Okay, so before I indicate the opportunities for a bullish halfway hesitation, I would note that the stumble the market made in this try higher 2 weeks ago and again last week, seemingly failing at the same level as the 15th of April, with the overhead resistance of the 50% Fibonacci line of November 2015 to March 22 move at 27.53, though this time also ably capped by the dark blue highlighted middle time, currently 28.70 of the recently drawn late April mid-May bullish Andrews pitch fork. The market has since last week headed lower into congestion between 26.66 and 26.80 and again at 26.50, and today punched and breached on the downside the lower time of the dark blue bullish Andrews pitch fork, and that's currently at 26.62. Now, this may just be a breach, but I have taken the cautionary step of drawing today a shallower bullish shift pitch fork for the same move as the bullish Andrews pitch fork, and that is highlighted in purple on my daily chart. The lower time for this is currently at 2600 and is just emerging from the mid-April, mid-May congestion that formed the seemingly failed bullish halfway hesitation between 25.20 to 25.95. This would be the next major support below. LME 3-month lead. The key resistance that kept this market capped during the first third of 2024 was, as I said 12 weeks ago, and I quote, "I suspect the key overhead resistance will be the same as in late January, congestion between 21.82 to 21.89. Please remember this quote as it will become relevant again. This capping action eventually brought forward the idea of the late January to mid-April action having a double bottom pattern type. It's here that I bring back in that earlier quote made 12 weeks ago, and I quote, "I suspect the key overhead resistance will be the same as in late January, the congestion between 21.82 to 21.89. End of quote. It had been this overhead congestion that capped the market throughout the beginning and the middle of April, barring one aberration, until 6 weeks ago when prices rode up through the congestion and reached both the primary and secondary targets for the double bottom type on the upside. On its journey higher, the market also reached the primary and secondary topside targets for the handle to the double bottom, as it acted as a bullish halfway hesitation. Finally, let's look again at the elephant in the room, something I've been calling it for 4 weeks now. The bright red highlighted mid-February to late March bullish Andrews pitch fork. Now, last week, I thought the breach of the upper time, currently at 23.59, was that, just a breach, and the bright red bullish Andrews pitch fork could repair itself. Well, it has repaired itself, but the pattern the market left behind over the last 2 weeks is distinctly bearish. It is a horn top, and today prices are trying for the second time to break down through the neckline of this pattern, this time with a potential combined key reversal down and bearish engulfing pattern. If they do, then an initial potential on the downside would be in the 22.15 zone, with a secondary harder to reach potential down in the 21.73 zone. Now, these are not targets as yet, as there has not been a proper break of the neck of the horn top. But I can nevertheless offer these as potentials on any such break lower should it happen. Now, there are obstacles on the way in any move lower. The first one is congestion between 22.63 to 22.68, which we've already tackled. Then the bright red middle time, currently at 22.52, which looks interesting. Then a free area down to the band of congestion between 22.09 to 22.25, containing many things. After that is the rising short medium moving average, currently at 21.90, and a less congestion band between 21.67 to 21.86. Though the recent pattern is quite bearish, the integrity of the bright red bullish Andrews pitch fork is still good. I also note the golden cross late last week on the medium moving average, currently at 21.48, up over the long moving average, currently 21.44. Please note this is a lagging indicator. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.